Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. In the uncertain post-pandemic world, a looming crisis in U.S. commercial real estate has caught the attention of financial experts and investors alike. Could history be repeating itself? Renowned portfolio manager Steve Eisman, famous for his accurate predictions during the 2008 housing crisis, believes so. Just as he foresaw the housing bubble's burst 15 years ago, Eisman now warns of a potential economic storm brewing in the commercial real estate sector. It's widely known that the pandemic precipitated a massive shift in work dynamics. People globally were compelled to work remotely, compelling companies to adapt to this new reality. The benefits of remote work are indeed evident, not only for workers but also for companies, as they realized they could reduce their office space footprint to save costs. This puts a lot of pressure on the property owners. In San Francisco, for instance, leased office space has dwindled by around 2/3 since the pre-pandemic era. This situation has led to a noteworthy decrease in rental income for the owners of commercial real estate. A specific example from San Francisco highlights this trend. Wells Fargo recently sold a 13-floor tower at 550 California Street for about $200 per square foot, a sharp decline from the market peak in 2019 when prices exceeded $1,000 per square foot, as reported by Newmark Group. Even with some companies now asking workforce to return to office, the need for office space remains significantly below pre-pandemic level. As a result, owners of these properties are facing diminished rental income compared to the pre-pandemic period. In New York and London, proprietors of offices are opting to relinquish their debt obligations rather than continuing to invest in a losing cause. The proprietors of Westfield San Francisco Center Mall are relinquishing ownership of the property to lenders, signifying the ongoing challenges within the city as it strives to revitalize its workforce and attract tourists post-pandemic. The gradual deterioration within the realm of commercial real estate resembles a somber thread weaving through the tapestry of the global economy. While stock markets surge and investors harbor hopes of a decline in the interest rate hikes witnessed in decades, the challenges within the property sector are poised to unfold over an extended period. Typically, crunch time arrives when their debt matures and needs to be refinanced. This is because, firstly, property owners must allocate additional funds during the refinancing process, which adds financial strain. And secondly, the interest rates on the new loans are considerably higher, compounding the financial burden for property owners. According to Bloomberg, a critical turning point is approaching. Approximately $1.4 trillion of commercial real estate loans in the U.S. are set to mature this year and the next, as reported by the Mortgage Bankers Association. The consequences are already evident, with owners facing significant debts contemplating default instead of borrowing at higher interest rates. This intricate situation highlights the immense challenges property owners are grappling with as they navigate the complexities of loan refinancing in an environment of rising interest rates. Even big institution entities like Blackstone, Brookfield, and PIMCO have made the strategic choice to halt payments on certain buildings recently. Their rationale is straightforward. They perceive better uses for their cash and resources. In essence, they are relinquishing these assets because they recognize their inability to meet the obligations of the new loans. This situation echoes the economic reality where initial purchases were made when interest rates were minimal, say 3%, and property values were deemed profitable, with cap rates around 3% or 4%. However, the landscape has changed. Borrowing now incurs rates of 7% or 8%. Consequently, the value of real estate has inevitably declined. What will be the consequences of a commercial office fallout? Well, here is a chart from Bloomberg that shows US commercial property loans by lender type. As you can see, commercial banks hold the lion's share of commercial or multifamily mortgage debt, accounting for 39%. As the challenges in the commercial real estate market mount, there's a growing worry that these issues could disproportionately impact banks. According to JP Morgan, particular attention should be paid to smaller regional banks as they hold 4.4 times more exposure to loans compared to their larger counterparts. Among these small banks, commercial real estate loans constitute a substantial portion of their assets, making up 28.7% in contrast to just 6.5% for larger banks. This discrepancy in exposure and potential risk between small and big banks underscores the potential ripple effects that this commercial real estate crisis could have on the broader financial system. Indeed, there's a graph from JP Morgan that sheds light on the various US banks and their exposure to commercial real estate, particularly in relation to their CET1 capital. In this graph, many banks display high ratios of commercial real estate loans to CET1 capital. JP Morgan defines any value exceeding 100 as risky. And as you can see, many regional banks have high exposures to commercial real estate. Several names with particularly high concentration in CRE include M&T Bank, SVN, and UMPQ, all with a ratio exceeding 200, and Valley Bank, which boasts a staggering 400% ratio. While the situation for office space might sound concerning, we would also want to remind everyone of the big picture. If we were to compare CRE to the broader US economy, we would find it relieving that commercial real estate only represents 2.4% of all physical assets across the country. On top of that, office buildings constitute only 14% of total commercial real estate assets, at just above $2 trillion. To put it into perspective, Apple's market capitalization is $2.8 trillion, larger than the entire capitalization of the US office sector. So after all, even a fallout in the office space may not be a big deal spreading to the broader economy. Moreover, banks could potentially engage in negotiations with commercial real estate owners to find solutions that prevent defaults. Considering the current market conditions, lenders may not be inclined to repossess commercial properties that would entail managing or selling them, particularly at stressed valuations. Instead of foreclosing, lenders might offer borrowers temporary forbearance or modify their loans. So, while there are concerns about the commercial real estate sector, there's room for optimism that measures could be taken to mitigate the potential impact. The unfolding of these events tends to take time, and the potential impact could be influenced by various factors, including loan extensions and debt restructuring. If certain rollovers can be deferred or managed through these means, it might prevent the situation from escalating into a full-blown crisis. JP Morgan captures this sentiment by emphasizing that while concerns about the office sector's impact on GDP are valid, broader concerns about confidence in the banking system, especially concerning smaller banks and their credit provision to the economy, are also relevant. They express a constructive viewpoint, highlighting that stronger fundamentals can be found outside of office buildings and vintage malls. They anticipate limited losses beyond these vulnerable segments of commercial real estate. And as for your thoughts, do you believe that this situation could escalate into another banking crisis, or do you perceive the office sector's impact as potentially too small to create a significant difference? Your insights on this matter are valuable, so feel free to share your thoughts on the situation in the comment section below. If you found this information valuable and insightful, don't forget to give the video a thumbs up. And thank you for watching, and see you in the next video.